In this lecture, we're going to talk about long-term notes payable. As an overview, the first thing we have to think about, what is the difference between the face value of a note and the present value of a note? Well, the face value is the amount that is going to be paid at maturity. It's the contractual amount that's going to be paid at maturity. The present value is the discounted cash flows associated with the debt. And those cash flows would include both interest payments and the face value that's going to be paid at maturity. But of course, we're going to apply a discount rate to any amounts that occur in the future. And so they are not necessarily the exact same thing. However, the face value will equal the present value of the note if and only if the effective interest rate implied by the debt contract within the note equals the most reliable rate that can be applied to the debt. And so if those two, if the effective interest rate implied by the note and the reliable interest rate, that's sort of more of a market measure of interest, if those are equal, then in that case, the face value and present value will be equal. Otherwise, the note will be issued at either a premium or a discount. And it was as one note. This is slightly different than current notes or short-term notes. If you have a long-term note, you have to use the time value of money to accrue interest. All right, so let's talk about notes that are issued at face value. First of all, again, this is a situation where the present value and the face value are equal. The interest rate implied in the notes contract is therefore equal to the most reliable discount rate. The nice thing is these are really easy because the interest payments and the interest expense are going to be exactly equal to each other. Let's talk about a slightly more complicated situation, although it's not too bad. Let's talk about a zero interest bearing note. This is a situation where the present value and the face value are not equal. And it's because the present value at issuance is going to be less than the face value. In other words, the note is going to be issued at a discount. And the amount of the discount is going to be determined by the most reliable discount rate. It's really important to note that a zero interest bearing note means that there's no contractual interest, but there still will be an interest expense. Recall, we incur interest expense as time passes. And so just because there's no stated rate on the note, it does not mean there will not be an interest expense. And so just wanted to clarify that. And so as the discount rate or the most reliable discount rate changes, then the amount of the discount is going to change. And so if the rate is higher, that means the discount is going to be greater. And of course, the difference between the present value and the face value is that discount balance. And the discount balance will capture the interest expense that will eventually be recorded over the life of the note. All right, let's do an example. Ford & Air Company issues a $50,000 zero interest-bearing note on January 1st, 2018 for $44,000. The note matures on December 31st, 2020. Provide all necessary journal entries over the life of the note. First thing we're going to do is record the initial entry, which is, of course, we receive cash of $44,000, and the face value of the note payable is $50,000. The difference between the two is the discount on the note payable, and in this case, it's $6,000. So that $6,000 basically captures the interest expense that will eventually be recorded as part of this note. Now remember, there's no contractual interest, so we're not going to have any interest payable, but we will be recording interest expense throughout the 3-year life of this note. After we record the initial entry, now we need to use the time value of money in order to record the rest of the note. Specifically, we're going to use the time value of money to derive the interest expense. And so in this case, it is a 3-year note, so the N is 3. The present value is $44,000. That's the amount that we receive when the note is issued. There are no contractual interest payments. And where the face value of the note is $50,000, that is the amount that's going to be repaid at maturity. We use this information and we solve for the imputed interest rate or the inferred interest rate or inferred yield on this note. And that is 4.3532%. We're going to use the information from our time value of money calculation and create an amortization table. Just like any other table we've done, we have the date and we have the initial carrying value of the note. And from there, we're going to basically amortize, and in this case, we're going to be amortizing the implied discount. And so the first entry or first line in the amortization table that we see here is at the end of 2018. The interest expense of $1,915 is the yield that we calculated within this note, and we apply that yield to the carrying value of the note, just like we had done with bonds. And so we can see that in this case, because the interest expense is unpaid, the carrying value of the liability is going to increase. So in the next period, in 2019 and 2020, that process continues. Again, we continue to apply the yield that's inferred by the note. We apply it to the updated carrying value, and from there we continue to accrue interest against the note until finally the carrying value of the note is equal to the face value. And so let's use the amortization table to start recording our entries for the interest expense at each fiscal year end. And again, this is the amortization of the discount. And so on 12/31/2018, we're going to amortize the discount on the note payable $1,915, which means we have an interest expense also of $1,915. We have similar entries for 12/31/2019. Of course, in this case, the interest expense is $1,999, and the amortization is also $1,999, again, because it's an updated year. All right, and then finally we have the maturity of the note, and on this date we have the interest expense, $2,086, as we see from the amortization table. That's also the last bit of the amortization of the discount, but in this case, on this date, we're also repaying the face value of the note of $50,000. And because we've held it all the way to maturity, it all kind of syncs up, and we end up getting everything off of our books. All right, now we're going to talk about notes being issued at a premium. So the present value of the note in this case is going to be greater than the face value of the note, and the interest payments are going to be greater than the market rate of interest or most reliable discount rate. In other words, we're going to be paying, the contract pays more interest than what the market demands, therefore the note is going to be issued at an amount greater than the face value. So we're going to amortize the premium using the effective interest method. If we had had discount note, which is also possible where there's interest payments, we would use a similar approach. All right, here's our example. Panther Company issues a 2-year note payable on August 1st, 2018. The stated rate on the note is 8%, and it's payable on July 31st each year. The $35,000 note is issued at $38,000. Provide all necessary journal entries for the company, and the fiscal year end is December 31st. Again, the initial entry hopefully isn't too bad. We received $38,000, and the face value of the note is $35,000. The difference then is the premium on the note payable. Again, the premium on the note payable is the issue price above the face value of the note. The next step then, as we record payments, is we have to use TVM in order to record our interest expense and determine the method that we're going to use to amortize the note premium. This is a 2-year note. We received $38,000. The contractual interest payments are $2,800, which again is 8% of $35,000. And the the face value of the note is $35,000. From this information, we are able to calculate the implied discount rate of 3.4887%. We're going to use that information to create an amortization table. We can see we have the issue date and the carrying value of the note, the initial carrying value of the note. And after 1 year, of course, we have the payment of $2,800. The interest expense is, again, we're using the yield that we solved for. We're applying it to that $38,000 carrying value, and we get an interest expense of $1,326. And so we're going to amortize the premium $1,474 for that period. Notice in this case, the interest payment is more than the interest expense. And so from an economic perspective, what we've essentially done is we've not only paid the interest that we owe, but we've also paid down some of the principal. I want to be clear, though, this amortization table is somewhat happening behind the scenes. The holder of the note doesn't really care what we're doing as far as our accounting. They're just wanting to make sure that we fulfill our end of the contract. And so this is just allowing us to reflect the true economics of the lending situation when we create our financial reports. Similarly, on 7/31/2020, we have the final interest payment. The interest expense, of course, is going to be slightly lower because the carrying value of the note has decreased. And the last bit of amortization of that premium needs to take place, and then we end up at the face value of the note as our final carrying value. We take that information in order to now do our journal entries. Now, in this case, because the interest payment dates do not coincide with a fiscal year end, we do have to partially accrue interest at the end of each fiscal period, just like we had done with the bonds. And so in this case, from the issuance of the note until the first fiscal year end, December 31st, 2018, our interest expense is going to be $1,326 times the 5/12 that have passed. And of course, the interest payable is also being accrued at 5/12, which is $1,167. And again, this is the contractual amount is the $1,167, and the expense is more of the economic perspective using the yield that we had solved for. And so then our entry is, of course, a debit to the interest expense and a credit to the interest payable, and amortization of the premium as the difference between the two. Then we have the subsequent payment on July 31st, 2019, and there is a remaining interest expense, which is just $773. So then our final entry, we have the interest expense, the previously accrued interest payable, the cash payment, and the difference then is the amortization of the bond or the note premium. Similar to the previous year, on 12/31/2019, we have to accrue 5 months of interest expense and accrue 5 months of interest payable. On that date, we have our entry of interest expense of $531 and interest payable of $1,167, and of course the amortization of the premium on the note is the difference. Then finally, with that final interest payment, we have the remaining interest expense of $743. And our full entry then is we have our interest expense, the previously accrued interest payable, and in this case we also are paying back the note. So the cash payment is not just the $2,800 interest payment, but also includes the repayment of the face value of the note. And that last little bit is the premium of $8,900 or $890.